Hi, I'm Deirdre McMurdy. Well, our next guest has two hard and fast rules when it comes to investing. Rule number one, avoid losing money. And rule number two, always remember rule number one. We're talking about and with Michael Hatcher. He's the portfolio manager for the Trimark Global Fundamental Equity Fund. He's also the head of Global Equities for Trimark Investments, and he's the director of research. Now, Michael, let's start right at the beginning. What inspired you to become a portfolio manager?
Yes, I started my career off as an economist. So many years of school, learning the economic principles. And what I found was I really wanted to move away from economics and into investing. So to do that, I needed to read as widely as I could. So I read as many books as I could, as many articles as I could. And I finally came across a book by an author named Roger Lowenstein, The Making of an American Capitalist, which is the biography of Warren Buffett. And it was the simplicity of just simply trying to uncover quality businesses and buying them for less than what they're worth, or buying $1 worth and paying 50 cents. That led me away from economics and into being a value investor.
Well, then maybe you could tell us a little bit about the process, the research, the analysis that goes into finding those companies, because I'm sure investors must wonder, how do you go about picking what goes into the portfolio?
The key for us is the quality of the company. So how I define quality, I'm looking for businesses that generate high returns, or high returns on their capital. So what do I mean by that is, for every dollar a company maintains, what return can they get on that? So a 15 or a 16, 17% return on capital. I'm also looking for companies that generate significant cash. But for that cash, it needs to be cash that sort of comes back to you as a unit holder. So these are companies that will, if you had $1 of earnings, let's just use an example, and you had an auto manufacturer that had to take 40 cents of that and put it back into the company just to produce the same number of cars, you don't really have $1, you really only have 60 cents. So we're focused on how much cash will actually come back to me as a unit holder. So a quality company is going to be something that has those attributes, and what we're looking for in order to make sure they have them for a long period of time is that there needs to be something, a competitive advantage or a barrier to entry that stops people from competing against those businesses, because that's what allows them to have these returns on capital and generate cash for long periods of time. So that's really what we're focused on, is that competitive advantage.
All right. Now, you have been managing the Trimark Global Fundamental Equity Fund for almost 4 years. Over that time frame, there's been nothing but negative news coming out of U.S. and Europe, and you now hold approximately 70% or so of your investments in these regions. But over the period of time you've been managing in those regions, you've done tremendously well, an 8.56 per year average rate of return. How do you do that?
You're apt to get your best returns when the news is negative. I mean, that's when most people don't want to be investing, and in actual fact, that's the time in which you're going to get your best opportunities. So, once the markets came out of the deep downturn in March of 2009, it's really been the economy's muddling along. So there's been nothing to get excited about on the economic front, but from that deep recession on the stock market, things have actually rebounded quite nicely. So those returns are really a function of owning high quality companies in a market that has been rebounding from a significant trough in 2009.
Now, the globe, as we all know, is a very big place, and a lot of global funds tend to own a lot of names, 150, 300 companies, but you've got a real focus on 75 companies or so. Why have you got 75 names only, and sort of, again, how have you picked and chosen among the herd?
Right. I would even argue 75 is a lot of companies to own in a portfolio, and this is a portfolio that I manage with my partner, Jeff Fang. So we have a very large team behind this portfolio, and the key for us, you need to understand the companies that you actually own within the portfolio. And for us to have 130 or 150, that's really a statement that you're owning a bit of everything and you don't really understand exactly what you actually have within the portfolio. So that's why we try to limit the number of names that we have in the fund, and we try to, it's really built company by company to make sure that everything in that portfolio is a company we believe has very good long-term economic prospects.
Well, Michael, for those watching us today, What would you say if you had to make the case for this fund and where it fits into people's portfolio? Let's say you're trapped in an elevator with a bunch of investors or prospective investors.
Strangely enough, we actually own elevator companies. So if we're in the elevator, we'd actually be looking at who's actually making the elevator and then along the lights. But this is probably a great example as to the type of companies that you would have or why you would want to own this fund for the long term is, most people don't realize with elevator companies, they think that it's sort of related to real estate or that it's highly cyclical because it depends on where the trends are going. But an elevator company, 80% of their revenue is actually based on elevator maintenance. And if you think about that for a moment, by law, every elevator and escalator needs to be maintained. So, regardless of what would happen in Greece, or if the next banking crisis is in Cyprus or in the Isle of Man, every elevator company, every elevator that still needs to be maintained, this company is essentially regulated to generate cash flow. So the barriers to this business is it's a density game. What's important for this is you need many buildings in a small area, and you typically will become the low cost operator. Very difficult for people to come in. So this is an example of a high barrier to entry business that generates a lot of cash and sustainable for a long period of time.
And is there a name in particular that you like in that sector?
We've been long-term shareholders of a Swiss company called Schindler, which is one of the 4 sort of large global elevator companies in the world. So typically when I go into an elevator now, I can't help but sort of scan as to who's made the elevator or who's actually maintaining the elevator. But that's why you would own this portfolio over long periods of time. It's companies like Schindler or like Walt Disney or businesses that have sort of very stable and solid cash flows that will grow over time.
Well, thank you very much for the conversation and the insight, Michael.
Great, thank you.
And for those viewers who are interested in learning a little bit more about the Trimark Global Fundamental Equity Fund, speak with your financial advisor.